So, as always, before we get into it, give this video a big thumbs up. So, I have a question for you. What is the right time to sell a stock? This is a question that has had many investors bewildered over the years. However, to answer this question, you must first ask yourself, are you an investor or a speculator? If you aren't sure, let me tell you the difference between the two. A speculator is a person who is only concerned with one thing: the change in the price of a stock. Speculators are people who like to place bets on which way a stock will likely move. If the stock does not respond the way they anticipate, they have no other option but to cut their losses and move on. This is one of the reasons why you will observe that speculators have a very short time horizon. The most extreme form of speculation is done by a day trader who buys and sells stocks multiple times a day. An investor, on the other hand, is someone who buys a stock not because it has recently shown positive price signals. Instead, he or she likes the underlying business that the company is operating in. The investor does thorough research and analysis of the industry and its competitors. The investor feels confident of the management expertise of the company and foresees good future growth potential. Therefore, an investor usually has a long-term investment horizon and is not too concerned with the temporary price dips and fluctuations that his investment might experience. For example, an investor who bought 1,000 shares of Amazon stock in January 2000, when it was trading at $63, would not be too stressed when it crashed to $15 a few months later. The Amazon investor who saw the long-term potential of the company and stuck with his investment would be over $300,000 richer today. In today's episode, we'll be looking into the fundamental investor instead of the short-term market speculator. Even though Warren Buffett describes an ideal investment as one that you can hold on to forever, this is not often that realistic. Sometimes, selling off the stock can be the best or the only option for you. However, you do not want to find yourself in a situation where you sold off a stock too early or too late. Just like there are rules for buying stock, you also need to follow some rules for selling your stock at the right time and at the right value. So, below are a few conditions in which selling a stock makes the most sense. Number 1. The fundamentals have changed for the business. Sometimes things don't work out as well as you anticipate. Yes, you did your homework, and all research and analysis indicated it as a good company to invest in. But many unforeseen things can happen that will make an investment lose its charm and value. Maybe there was a change in management and a change in vision. Or maybe there were changes in the regulatory landscape, which slowed down the growth of the company. And there could be 1,000 other reasons like this. Maybe you invested in an industry which has suddenly gotten outdated due to some new disruptive technology introduced in the market. For instance, there's a chance that in the next 50 years or so, the gasoline automobile industry will get completely outdated as electric vehicles become more widely used and become a permanent household feature. Maybe the gasoline cars will instead become more of a collector's item, while electric cars become the go-to vehicle for daily usage. Several indicators can tip you off regarding the decline of a company's performance. Usually the price of the stock starts to head south, and you get the feeling that it's not going to stop falling anytime soon. Abnormal price movement is usually one of the earliest signs of something bad happening to a company. This is later validated once a company's annual information is made available, and you see that the financials have taken a hit. Financial ratios analysis can help you determine the profitability and financial position of your company. Some of the ratios that can be helpful in your analysis are dividend yield, price to earnings, earnings per share, dividend payout, debt to equity, current ratio, etc. If you observe that the fundamentals of your company have weakened, that is a good enough indicator that you should think of selling your stock. The number 2 is when companies eliminate or reduce their dividends. Although this is in some ways connected to the first condition that I just told you about, I wanted to highlight it separately because it's that important. When a company suddenly announced that they're going to pay less dividends this quarter or not going to pay you any dividend at all, this should be a red flag to investigate the financial performance of the company. Usually, a company will do this if they have consistently not performed well in the past few quarters. And this is a good time to reevaluate your investment and maybe sell it off. You must, however, be completely thorough with your research as to why the company has suddenly stopped paying dividends. Maybe the company is just looking to expand its production facilities and will be reinvesting the dividends. Or maybe it's going to invest it in research and development.